Well, good evening. We want to welcome all of you to this very special occasion. My name is Bill Hudnut. I'm the Executive Director of the Real Estate Program here at Georgetown's School of Continuing Studies. And this is the conclusion of our lecture series. Our well-known, nationally recognized, famous speaker is going to be introduced by one of our professors. Dr. Frank Northaft is the teacher of the urban economics class. I hope some of you are in that class. Yeah, I see them nodding. Frank, give them all an A. But the program this evening is basically as follows. Mark Zandi will be speaking after he's introduced for as long as he feels it's right. And then we'll open it for questions and answers. And when those conclude, when it feels right, we will adjourn, and you're all invited to go down one flight of stairs for the reception and some nice goodies, which we're going to have a little later on, like at 7:30, if we go that long or before. We encourage you to pick up some of the literature, particularly those of you who might be interested in the CREW event, the Commercial Real Estate Women's Group, which is out there. And they're having a meeting here, and they wanted to promote that. But we are so happy that you're here. And without further ado, let me introduce Dr. Northaft. He works at Freddie Mac, has his PhD, and he is the vice president and chief economist for Freddie Mac. And he and Mark have known each other a long time. And it's with pleasure I introduce Dr. Northaft to introduce our speaker.
Well, thanks so much, Bill. It's certainly my pleasure to be here and to introduce Mark this evening. Mark is not only a very good economist and a very good colleague, but he's also very generous with his time. In each term that I've had the opportunity to teach here at Georgetown, Mark has made himself available to come and give a special lecture, and I really appreciate that, and the school very much appreciates that too. And here we are in our new location, the School of Continuing Studies, right here, brand new location downtown. So I'm glad you've had a chance to come and see the new facility that we have here. Mark Zandi is chief economist at Moody's Analytics, but more than just that, Mark is also very much a trusted policy advisor, and that's very important here in Washington, where it's very hard to bridge the gap across political parties, but he's very much trusted by both members of the Democratic Party and the Republican Party. He's testified up on Hill a number of times. He's advised the Obama administration on a variety of issues, many of them related to housing finance policy. He also served as an economic advisor to Senator John McCain during his presidential bid, too. So a very rare person who can bridge both camps. Mark also has 2 books out there. Amazon.com, is that where they can get them?
I haven't looked recently. I
haven't
assume
looked.
hopefully they're still up there, yeah.
So he's the author of Paying the Price, Ending the Great Recession and Beginning a New American Century, an assessment of monetary and fiscal policy response to the Great Recession. And his second book, Financial Shock, a 360-degree look at the subprime mortgage implosion and how to avoid the next financial crisis, described by the New York Times as the clearest guide to the financial crisis. So that's a pretty good endorsement right there. Mark has his degrees from the Wharton School and his PhD from the University of Pennsylvania. And I know Mark has a lot of passion about baseball, especially his Philadelphia Phillies. So hopefully he'll share with us, too, his prediction for the NL East. And it's a very partisan crowd here, Mark, okay? So, okay, well, welcome, Mark.
Thank you. That's fine. Thank you, Frank. Thank you, Bill and Georgetown, for the opportunity to be here. So I have 2 hours to speak? No, nothing worse than an economist. As long as I want. That's dangerous. I can speak for 3 days, really. How about if I go on for half hour, 45 minutes or so? Actually, before I dive in, because there's a lot of things we can talk about, I'm not really sure what you want to talk about. What's bugging you? What is it that you want me to address? What are your questions to me? Now, I know this is urban planning, real estate. My sense is that you want to talk a little bit about commercial real estate, housing markets, and I can do that. But what else do you want to talk about? What's bugging you? Yeah.
I'll say affordability of housing,
Housing affordability?
interest rates.
A lot of things are bugging you then. Okay, yeah. Interest rates, housing affordability. Okay. Okay, good. What else? What else? Yeah.
Housing finance reform,
Okay.
view on what's going on in the Senate.
Okay. Johnson Crapo and the lay of the land and, okay, sure.
The future of the GSEs.
Okay, similar question, future of the GSEs? Yep.
Market entry,
Market entry. And can you give me a little more context?
just
Which market?
the real estate, well, commercial market.
Okay.
So just trying to identify a good point to really enter or not enter, so to speak, based off of the facts and information that we have.
And what do you do, sir? What do you do for a living?
I'm an IT consultant,
IT consultant?
big data.
Uh-huh. And when you say enter in, you mean as an investor?
Correct.
Oh, I see. Okay. So you want to know how to make money?
Yes.
Yeah, in the real estate world. Okay.
They all do.
Yeah. Can't help you with that, unfortunately. Yeah.
The economy seems to have several tiers, some of it, a lot of it geographic, a lot of it industry specific. And your title of CRE is set to break out. I'd be curious to hear your differentiation by geography, by industry type,
Okay.
and the collective impact of all. Is there enough oomph to bring everybody up, or are we really gonna have some of it's gonna be good here, some of it's gonna stay stagnant here, kind of?
Okay, good. So what's going to really drive this breakout across regions of the country, industries, occupations, that kind of thing? Yeah, sure. Are most of the folks interested in commercial real estate? Yeah, okay. Housing? Okay, move forward there. Yeah,
If there is going to be another real estate bubble, but if there is, you look at which asset class
okay. Which asset class is most vulnerable to bubble-like conditions? Yeah. Okay. Good. So another hand up here somewhere. No? Anything else? Anything else bothering you? Up front? Yeah.
specific to DC to continue developing the Southwest and Southeast?
Southwest DC. Okay, that's really I give you my 3 cents about almost anything except for that. Yeah. That's really stretching it. I will say I have economists that work for me that do in fact follow the DC metro area in detail. For a lot of commercial real estate folks. So if you give me your card, I can get you in contact with them and they can give you their views on that. Yeah.
Southeast.
Pardon me?
Southeast.
I'll think about it. Yeah, I'll think about it. Yeah.
Our reliance on fossil fuels and how shifting perspectives on energy usage will impact either positively or negatively urban growth and transition.
Okay, great. So the sort of the very seemingly very positive energy story that's developing, what kind of implications that might have. Right. Okay. Good. Anything else up? Yeah.
There's something about the trend in rental rates. I read an article where rental rates are increasing over the past, where it's been like 4 times.
So really, you're talking single-family rental or in the housing market, right? Multifamily rental. Okay.
I think it was like, that's supposed to be 30% of your salary.
Yeah.
And most cities like New York, LA.
Right. Right. Okay. Good. Rents. Good. All right. All very good questions. I will endeavor to address all of the questions in my remarks. If I don't, it's possible I could miss it. I definitely won't address the Southeast, Southwest question. So you can repose. And I reserve the right to ignore you again, but you can repose. Let me begin by saying that I'm optimistic about the economy's prospects, about the prospects for housing, and the prospects for commercial real estate. In fact, a large part of my optimism with regard to the broader economy is a function of what I think is going to happen in the housing market and commercial real estate markets over the next, well, really over the next several years. I don't sense a bubble, even overvaluation. The exception might be multifamily in major markets. It seems a little on the richly valued side. Cap rates have come in quite a bit. But I'm hard pressed to say there's, at this point, any real concern about valuation or bubbles. So I'm optimistic. And just to give you numbers, just to make it concrete, GDP, that's the value of all the things that we produce, that's been growing about 2% per annum. Really, since the recovery began. It's hard to believe, but the recovery is now almost 5 years old. It'll be 5 years old in June. Hard to believe it. We've been growing 2%. That's what we grew last year. We'll grow close to 3 this year. And that means the rest of the year's got to be pretty good because Q1 was pretty bad. A lot of that, and I don't have to tell you this, the weather was pretty awful. And that did a lot of, really weakened the economy first part of the year. But I expect things to rev up pretty quickly here and it to be a pretty good year. And 4% growth in 2015. And that is, that's largely related to my expectations for housing and to a lesser degree commercial real estate. That means more jobs. We created 2.5 million jobs last year. Our run rate currently is about the same. I expect 2.5 million this and close to 3 million in 2015. And so the unemployment rate will decline. We're at 6.7% on the unemployment rate. Full employment is at least a point lower, let's say rounding 5.5%. If everything sticks roughly to my script, we'll be back to full employment by late 2016. To be precise, November 4th, 2016. And I'm not really joking. It's going to be something close to that. We'll be back to full employment. There's several reasons for this optimism. Reason number one is almost as close as it gets to arithmetic when it comes to economic forecasting, and that is fiscal policy is set to become much less of a drag on economic growth. We've been in a period of very significant fiscal austerity for the past, well, really 3, almost 4 years. The austerity hit its apex last year in 2013. If you total up the impact of the tax increases, and there were many tax increases last year, and spending cuts, the sequester, you may remember, was last year, that shaved 1.5 percentage points from GDP. So we grew 2% last year. If fiscal policy had simply been neutral with respect to the economy, we'd have grown 3.5%. And that really is the growth in the private economy. The private economy grew 3.5% last year. And that's about the second, third year in a row that we've been growing that fast. You get a sense of that here. This kind of puts it in relief. The orange line represents total GDP growth, percent change year ago. This is data from Q1 '09 through the fourth quarter of 2013. The blue line represents government spending. This is all government spending, federal, state, and local. So you can see it's been more or less declining throughout the period. This doesn't include the effects of the tax increases, only spending cuts. And then the green line represents essentially the difference between the two. That's the rest of the economy, the private economy. And you can see that it's been growing between 3 and 4% throughout much of the economic recovery. In most historical periods, that would be considered to be pretty good. Now, The good news is that under current law, so if lawmakers do nothing, if Congress and the administration do nothing, and odds are very high they will do nothing, for the foreseeable future. They've got a budget deal that's in place for this year and next. They've raised the debt limit on Treasury debt out until next year. So nothing's going to happen. This is an election year. And if they do nothing under current law, the fiscal austerity fades quite dramatically. It goes from 1.5 percentage points of GDP growth last year to 0.4 percentage points this year. And that includes the expiration of the unemployment insurance program, which has already occurred. That was another reason why growth in the first quarter was slow. The program expired at the start of the year. So that's pretty compelling, right? I mean, fiscal policy is going to go from being a drag of 1.5 points of GDP to 0.4%. That's a swing of a full percentage point, and that's happening this year in 2014. Next year, under current law, no change. And again, I think that odds are pretty high that there won't be any change. The drag essentially goes to zero, and the fiscal austerity is over. I'm not arguing that we've solved our fiscal problems. We haven't. Our debt to GDP ratio is very high, double what it was before the recession. And under current law, if you go out towards the end of the decade into the next decade, because of rising medical care costs and the impact on Medicare and Medicaid, and also Social Security to some degree, we've got big fiscal problems as we move into the next decade. But that's not going to weigh on economic growth, I don't think, to any significant degree in the near term, in 2014, 15, and 16. We've done the minimum we need to do to stabilize the fiscal situation. That's over and that's done with, and we'll address this other longer-term problem later. When it's not my problem, it's your problem. You're going to have to try to figure that out. The second reason for optimism with regard to the outlook is housing. I'm quite optimistic about housing's prospects over the next several years, really over the next 5. And the reason is, the principal reason is that the level of construction is just very, very low relative to what we need to replace or to meet the demand for new housing. Get a sense of that here. This shows the number of vacant homes for sale, rent, and held off market. That's the green line. This is census data from Q1 90 through Q4 2013. You can see the number of vacant units rose pretty considerably during the bubble. And you can see, you kind of get a sense of how overbuilt the market got by comparing the green line with the orange line, which just is a very simplistic trend line. That's the level of number of vacant units you would expect in a normal, typical housing market. That, the housing stock is increasing at an equilibrium vacancy rate for homeowner vacancy and rental vacancy. That's the kind of trend vacant number of units you would get. And so you compare the two, that gives you a pretty good sense of whether the market's overbuilt or underbuilt. And it was obviously significantly overbuilt coming out of the bubble, going into the recession. But since the recession hit, the level of construction has been very low, and even given weak demand, we're working off these vacant units. And you can see as of Q4 2013, admittedly this is somewhat simplistic analysis, but I think it makes the point, and it's a correct one, that the market's pretty well balanced, that the number of vacant units out there are pretty consistent with what you would see in a typical market. In fact, some markets are undersupplied. So here's a little bit of geography, mental geography. I'll test your map skills here. Everyone knows where Bismarck, North Dakota is, right? Okay, think where that is. Somewhere out in the middle of the country, I know. And it's north. It's cold. It's not southwest or southeast. It's north, central. Draw the line down the middle of the country to San Antonio, Texas. Go 300-400 miles on either side. Admittedly, there aren't a whole lot of folks in that geography, except for Texas. There are a boatload of folks. Believe it or not, there are a lot of people in Texas. That geography is pretty tight, and the market is undersupplied. In fact, if you go into Texas, house prices, rent growth are very strong in Dallas, Houston, San Antonio, Austin, reflecting this undersupplied market. I think, given where construction is today and given where demand for new homes are, that a year from now, we're going to see spot shortages in many other parts of the country. 2 years from now, it's going to be a real problem. 3 years from now, unless construction really ramps up, very, very significant issue. Rent growth has picked up, is stronger. It is gobbling up a higher share of disposable income, and this is going to become more of an issue, at least for the foreseeable future until construction ramps up. But I expect construction to pick up, and just to give you a sense of the magnitudes here, the current level of housing construction, single-family, multifamily, manufactured housing, is 950,000 units. So today we got, it might be a little bit higher than that. Today we got a housing starts number, came in at 960,000 units. Throw in 40K for manufactured housing. These are all annualized numbers. Say we're at 1 million, okay. In a typical housing market, not even a really good one, we need to put up 1.7 million units. You can see in the chart how I get there. 1.15 million households should form every year. 375, and by the way, there's probably a fair amount of pent-up households out there, the 20-somethings that couldn't get work. They doubled up with parents, stayed with parents longer. So if you look at census data, there are roughly 1.5 million more 20-somethings living with parents today than prior to the recession. Those households will form. I can attest to this personally. So I have a son, 3 kids. My son just graduated, well, he graduated last May from Wake Forest. I know it's not Georgetown, but you know, it's Wake Forest. And he got his degree in philosophy. He knows Immanuel Kant very well. We were perusing Critique, believe it or not, Critique of Reason last night. I can't remember why he pulled that out, but I'm sure the meaning of life was in there somewhere. Couldn't get a job, so he came home. Actually, I thought it was kind of nice to have him home for a while. We had a banner day in the Zandi household about 3 weeks ago. He got a job. He's going to work for a real estate developer in Philadelphia. Interesting company, small company. They are starting a nonprofit using Section 130, Law 130. You guys know this probably me. There's a Law 135 in Maryland. It's in Philadelphia, where you can go. Nonprofits can go in and scarf up vacant property, and then develop the property, sell the property, and at that point the title changes over, and the nonprofit gets some money, and you move on to the next set of vacant properties. I'm sure I botched that, but that's kind of the gist of it. So it sounds fascinating to me, and certainly a need. I can't remember why I brought this up. The reason being, as soon as he had the job, I'm not kidding. 2 hours after he got the job, he's on Craigslist looking for an apartment, right? So a household's going to form right away. So that's going to happen. So we're going to get a year when we're above 1.15 million. It could be 1.3, 1.4, some big year. And frankly, I expect that to be in 2015. Obsolescence, that's just hurricanes and normal tornadoes, normal obsolescence. Second home, vacation homes, that's a lot of 50-year-olds, my age. High-income groups are doing quite well, thank you, and stock market's up and thinking about second vacation homes. You add it all up, 1.7 million. 1 million to 1.7 million, that's an increase of 700K. That's a lot of economic activity and jobs. So for every single family home that's put up, that creates 3.5 to 4 jobs over a period of a year. Every multifamily property unit that goes up creates almost 2 jobs. Yeah, you do the arithmetic. That's a lot of jobs in a lot of communities, and that gets us a long way to getting back to full employment over the next couple, 3 years. Let me say I am very convicted about where we're headed, that we're going to get to that 1.7 million. I'm not quite as convicted with regard, don't laugh, how fast we get there. There's a lot of constraints in the housing market that may take this a little bit longer than anticipated. And for a macroeconomist looking at the housing market I try to look at it from 10,000 feet, but my inclination is to look at it at 30,000 feet. I miss some of the sort of nitty-gritty things that kind of muck up my forecasts. Like, can builders get construction land development loans? So, big publicly traded builders, no problem, but half the construction market's non-publicly traded smaller builders, can they get loans from banks? Can I get enough forklift operators? Can I get enough people to truck the material around? I mean, I talked to small builders, even big builders, and they're having trouble finding qualified, believe it or not, people with certificates to operate trucks, and so it's hard to move stuff around. There's also things going on in the mortgage market that could slow things down. The availability of credit is tight, particularly for first-time home buyers. So a lot of the recovery in the housing market has been investors coming in, scarfing up distressed property, fixing the property, renting it, and that's driven a lot of the demand. That game is over because prices are now higher, so the spreadsheets you can't get the returns that you need. So investor demand has come down, and there's not as many distressed properties out there anymore. And we need first-time homebuyers to step up. Investors don't necessarily need a mortgage credit, but first-time homebuyers obviously need a mortgage, and the credit box is pretty tight. If you look at the average credit score for loans to purchase a home sold to Fannie Mae, sorry, I just know the Fannie Mae data, Frank. I'm sure you're better than this, but Fannie, it's about 740, 745. That's the average score. Just for context, the average American has a score of 700, so that's kind of in the middle of the distribution of scores. And in a typical housing market, and I'm not talking about 05 or 06, but I'm talking 03, 02 markets produced, the score would be about 700. The difference between 700 and 740 is pretty large. There's roughly, say, 9, 10 million potential homeowners sitting there, renters that could be potential homeowners that are in that score range. And so we need to get that down. Now, there's a lot of reasons why why lenders are cautious, but we have to work through those. I'm counting on the credit box opening. It feels like it's starting to open. So for example, Wells Fargo, a couple, 3 weeks ago, announced that they're going to take FHA loans down to a 600 score. Previously it was 640. So Wells, being the largest mortgage lender in the country, is now opening the credit box for FHA borrowers, which are first-time home buyers in many cases. So it feels like we're moving in the right direction, but we have to get there. And it may not get there quite as quickly for the spring selling season, the summer, as I'm hoping. So we might not get the ramp up in housing activity that I expect. But I am very, very convicted about where we're headed and what it means for economic growth. We're going to get a lot of construction in the next few years. This is probably a good place just to chat a little bit about housing finance reform. Housing finance reform is probably neither here nor there for my near-term forecast. Doesn't matter. The pipes are working. The status quo is okay. It's not great. I mentioned the credit box being tight. In part, it's tight because of the fact that Fannie and Freddie are in conservatorship, and it makes them more conservative in terms of their reps and warranties and how they work with lenders. It's certainly not very good in the long run. I mean, in the next recession, if there are mortgage losses, and there will be, and Fannie and Freddie are still in conservatorship, there's a pretty good chance that they'll have to go to taxpayers and ask for a contribution, right? I mean, there's no capital. And so that isn't going to go over too well with everybody, and it might force the Fannie and Freddie to raise their G fees and tighten up on credit at just the wrong time, just like FHA's been kind of doing to try to get its financial house in order. And so it's not, and you don't want to be here in the long run. The pipes are working, but unless you really keep working on the pipes, they tend to erode and start to leak. And we've got issues with Freddie Securities and liquidity with Freddie Securities, and it's not clear how that plays out. And there's a lot of other things that could start to break. So we don't want to stay here, but I don't think if we do, and the odds are we will over the next few years, least over the next couple of years, that it's not going to make a big difference in terms of my outlook for housing and for the broader economy. With regard to where I think we ultimately should go, and I think we will go. And I'm an economist, and I believe everyone is motivated by economics, and the economics win the day. Ultimately, people lose their minds for a while, and then the economics take over, and we ultimately get to the right economic solution. That generally works out for me, not all the time, but that generally works out for me. So I think the economics are that we're going to get something Johnson-Crapo-like. There has to be a government backstop. You just don't have 30-year fixed-rate prepayable mortgages without some government backstop. That's a fact. They're nowhere else in the world because there's no government backstop. The government backstop has to be explicit and paid for, priced appropriately. I think that's highly doable. And that's in Johnson-Crapo. You want a boatload of private capital in front of the government guarantee. That's Johnson-Crapo. You want to be sensitive to underserved markets. That's the only way something gets passed. I mean, even if you disagree with that statement. And I think Johnson-Crapo addresses the affordable housing question in a very graceful way. It eliminates the housing goals, which I think are very ineffective and not very helpful, cost a lot of money. And most of the benefit goes right to, previously went to Fannie Freddie shareholders and stakeholders. It didn't go to the groups that were intended for it to help. And so Johnson-Crapo has a reasonable attempt at addressing that. There's some things I don't like that, ultimately I think will get addressed. It allows for vertical integration in the market, which cuts down on potential competition in the marketplace. That'll be solved. I think no one really likes the idea of having institutions that can originate, aggregate, securitize, and guarantee. That doesn't make a whole lot of sense to me, and I think that'll be resolved. The one interesting debate, there's a lot of interesting debate, but one interesting debate about Johnson-Crapo is around capital. And the headline is that they want 10% capital. Which is a boatload of capital, private capital in front of the guarantee. In fact, it's if it were 10% equity capital, that'd be nuts, right? Because Fannie Mae and Freddie Mac cumulative loss during the recession was about 4%. So we want 10%, and the quality of mortgages going into the system now and forever more will be much higher than what was in the system pre-crisis. Just another point of context, the U.S. banking system, I'll ask you, what were the 2 worst years in the U.S. banking system's history in terms of loss rates? What do you think it was? Who said 1933? Okay, you get a copy of my book if you want it. Only if you want it. It's worth $3.99, yeah, and falling. So give me your card and I'll send that to you. Yeah, 1933, 1934. You add up those 2 years, the cumulative loss rate in the U.S. banking system across all assets. And remember, 1933, 1934. I mean, that's pretty bad stuff. Was 10%. So we're saying we want 10%. So that doesn't make any sense. So it doesn't make any sense in the context of how much capital is required of the banks to hold mortgages on their balance sheet. So if you look at capital rules for the banking system, Basel III, it comes up to 4 or 5%, depending on the banking institution. So it seems to me you'd want capital that's equal to 4 or 5%. That makes sense to me. That would be, that'd be, I think, appropriate. And interestingly enough, Johnson-Crapo creatively gets to that 4 or 5% equity capital in an incredibly creative way. And I'd love to know who actually came up with it. Because it's beautiful, actually, but from my perspective. I mean, I get excited about weird stuff, but it was really, really beautifully done. And they still are able, given the way they designed it, to get to the 10% headline, political headline that it's 10% capital. So it really, they threaded the needle on that one, I thought. Now, like any piece of legislation, am I going into too much detail? Is this too much detail? Yeah, it sounds like it is. I'll move on quickly. it's like any piece of legislation is like reading a religious text, right? I mean, there's a lot of interpretation, and the way I interpret it may be different from the way other people interpret it, and that is partly why there's a lot of angst here. And as a result, Johnson Crapo is, it's not going to go very far, and ultimately won't become law. But my point is, when we do get a piece of legislation, and we ultimately will, because we'll figure out the status quo isn't really going to work for us, that it's going to feel very Johnson Crapo-esque, at the end of the day, very, very similar to that. Just one other point about housing, because someone asked about the sort of regional. This is kind of gives you a sense of metropolitan area markets across the country in terms of house price valuation. If you're a metro in green, you're undervalued, and this is based on a number of different approaches, some heuristic measures like price to income, price to rent, and some econometric measures, or statistical measures. If you're red, you're significantly overvalued. You can see Miami looks significantly overvalued. A couple of San Francisco is definitely overvalued by these measures. Not that these are markets that are going to correct anytime soon. There's a long way to run here for various reasons, but kind of gives you a sense that the market broadly, regionally, is in pretty good shape, both in terms of supply and in terms of house price valuation. So I'm pretty optimistic about the housing market. I'll give you one more reason for optimism, and that is fundamentally the U.S. economy is in really good shape. We've righted a lot of the wrongs. You can see that in the banking system. I'll come back to that in a few minutes. You can see it among households. They've delevered. So a lot of it's involuntary, obviously foreclosure, but the upside to that is that you clean the balance sheet, and so debt service burdens of households are at record lows. And you can see here at businesses, American companies, non-financial businesses are incredibly profitable. I'm showing you data back to World War II, and the profit margins are about as wide as they've ever been. American companies have done a marvelous job of reducing their cost structures, and they're very competitive. Unit labor costs, which is labor compensation per unit of output and therefore accounts for productivity, best measure of international competitiveness. That has not changed in a decade in the United States. And in manufacturing, where competition is most fierce, it's not changed in 25 years. And this is very different from every other major economy on the planet. So if you look at unit labor costs in Germany, in China, in Brazil, they've all risen quite considerably. So the U.S. is incredibly competitive. And the energy story is really quite compelling. It appears that we're going to be enjoying below global market energy prices, particularly natural gas prices and electricity prices, because natural gas drives a lot of electricity, for at least a decade. We're sitting on natural gas, even with the cold weather, we're sitting at $4.50 per million BTU. That's about half the average global price. And if you talk to folks in the industry who know and who have invested in the industry, some of whom are my clients, they'll tell you that if prices ever get to $6 per million BTU, there's just a whole ocean of natural gas that's profitably developed at that price. So what that means is that we're going to have very low prices, electricity prices, natural gas prices for a long time. They'll probably get into our transportation network, trucking system, which reduces our reliance on oil and fossil fuel. And you can already see that beginning to happen. And it's going to lift our manufacturing base because the manufacturing base is very energy intensive. We're going to have some LNG to ship some of it over to Europe. That's going to take a while to happen, but that's going to also occur. And oil prices should remain relatively low as well. There'll be ups and downs more in oil prices because of the global market, and it's affected by geopolitical events. But in general, I think we can count on real oil prices being stable for the foreseeable future. So I think the energy story is incredibly compelling, and just adds to the optimism with regard to the competitiveness of the U.S. and American companies. Now, you may be asking, well, why is it that companies really haven't kind of stepped it up here? We've been stuck in a 2% world for quite some time, and all these dynamics now have been in place for a while. I mean, profitability's improved for quite some time. So what's going on? I don't know for sure, but my sense is that the missing ingredient really has been a lack of confidence. That business people essentially have been shell-shocked by what they went through, and they've been buffeted by shocks that are very difficult to gauge. European debt crisis is an example of that. How do you handicap whether there'll be a Eurozone crack-up? I mean, it's very difficult to attach a probability to that. And if you can't attach a probability to something, it's not that you lay off workers, it's not that you cut back on investment, but you certainly delay, you pause. I also think the vitriol in Washington has had a large impact on confidence. I think when you shut down government and you debate the merits of defaulting on the Treasury debt, that does a lot of psychological damage. Again, in the context of a very fragile collective psyche, given what we went through. And frankly, I do think reform, healthcare reform, financial regulatory reform, and I'm not commenting on the merits of those reform, but those are big reforms, and they mean a lot to business people. It scares them, and again, when you're nervous and scared, you tend to freeze. You don't take risk. I sense, though, businesses really, since we resolved the government shutdown and extended the debt limit, the businesses are feeling much better. And this is hard to measure this, obviously, but this is one attempt at it. We run a survey off one of our websites. It's a weekly survey our clients participate in, about 250 respondents every week. And this data here is on a monthly basis. I started the survey back in 2003, so I have 11 years worth of data. And you can see, kind of correlates with probably your expectations. And in the recession, it collapsed and it came back. And really, since December, it's been at a record high. And this is if you kind of relate this to economic growth, a value of 20, this is a diffusion index, so that's a percent of positive responses to the survey less negative responses. So if you have 20% more positive responses, that's roughly consistent with an economy that's growing at its potential. So anywhere between 20 and 30, you're growing at potential. If you're above 30, you're growing above potential. That, in the US, potential growth right now is about 2%. So what this would argue, if the historical relationships hold, is that we should be off and running here. In fact, I think, what we're going through here is not atypical. I've now lived through 3 full business cycles, so I've observed 3 firsthand as a professional economist. And if you go back a decade ago after the tech bubble, or go back 2 decades ago after this S&L crisis, we had recessions. And there were a number of years after those recessions, we were recovering, but we really didn't kick into gear, and everyone was hand-wringing about why we weren't growing more quickly, the jobless recovery, what's going on. And then you get to a point where business people will say, I can't continue to grow my earnings by cost cutting. I've done that. The only way I'm going to be able to grow and maintain my stock price and my value of my company is to look for revenue opportunity and take a chance. And that's when they step up and they invest and hire more aggressively. And I would call that a kind of a field of dreams moment, because when you take that chance, it's a leap of faith, right? I mean, everyone's planning, deciding what they want to do. Large companies, I'm part of a large multinational corporation now. I observe how they plan, and it is very disciplined and very rigorous. They think about it very carefully. It's not that they execute on it, but so they've got everything in place. And once they feel good about it, they're going to jump. But that's a leap of faith. It's a field of dreams moment, and we haven't quite gotten there yet. But I sense that happening. In fact, I think it happened today. Just literally today, something's changing, and we're going to get much stronger economic growth going forward, and we'll be off and running. Let me give you a few other, I'm taking a lot of time, I've covered a lot of ground, but let me give you a few more reasons for optimism with regard to commercial real estate. I've really been focused so far on the demand side for real estate, what's going to drive growth and principally jobs, because jobs are key to absorption and ultimately nothing works unless you have absorption of space. We're going to get continued multifamily absorption. I think office will begin to kick into a higher gear. Hotel absorption's already picked up. Retail, a little less optimistic about that just because, I think the sources of growth are shifting from consumer spending to more investment, export-oriented. But nonetheless, we'll get more retail as well. But the supply side is also a very positive story, and that is that the level, I mentioned the level of construction in the housing market as being very low. The level of commercial real estate construction is also very, very low by historical standards. And you can see that here. This shows multifamily construction as a share of GDP. This is data from 1960 through 2013. This is annual data. And that's the orange line. You can see that we've come off bottom, but we're very low by historical standards. And if there's any part of the commercial real estate market that's made its way back in this recovery, it's multifamily. We're getting 350,000 units per annum, and that's considered to be pretty ample supply. But despite that, you can see by historical standards, it's still quite low. And then even more telling is the rest of the CRE market. So commercial would include everything, basically everything else: office, industrial, hotel, retail. It also includes a bit of healthcare is in there as well, private healthcare. And you can see that as a share of GDP, we're at 0.75%. So that's 75 basis points, which is well below historical norms. So we've got a situation where we've got what I would expect to be stronger absorption and demand combined with still very weak supply. And the combination of those two things would strongly suggest that we're going to see declining vacancy rates and in better conditions. It's also important to note that credit is becoming more available. So to act on this improving dynamic of demand and supply, we do need credit, and that's certainly starting to come from the banks. I mentioned earlier the banking system is in very good shape. You can see that. The green line is the core capital ratio for U.S. commercial banks, and that's the left-hand scale. I had data back to 1934 when the FDIC was put on the planet, and the current core capital ratio, this is really Tier 1 capital, so this is really high-quality capital, is as high as it's been in the data that we have back to 1934. The liquidity is very strong, margins are wide. The only missing ingredient for the banks is loan growth, and you can see that they are starting to lend more. The orange line, right-hand scale, is the year-over-year percent change growth in commercial real estate loans made by banks. And you can see we were in a period of declining lending, outstandings were declining, but now we're in positive territory with growth in mid-single digits, and the trend lines are very positive. We're going to see a lot more CRE lending. And the capital markets are also opening up and providing credit. The commercial mortgage-backed securities market is definitely coming back to life. This is Moody's data. We're not back to 05, 06, 07. That's pre-crisis. Things were obviously a bit frothy. Look at 08 and 09, the market basically came to a standstill, but we're now back. In 2013, there was over $100 billion worth of CMBS issuance, and I'd be very surprised if we don't go over that mark this year as well. So we've got improving demand, we've got low levels of supply, and we've got more credit coming into the marketplace. All of that argues for better conditions. And of course, investors recognize this. This isn't big news. They recognize this, and they've driven up prices for commercial real estate values. And you can see that here. This is price indices for different segments of the commercial real estate market. Again, this is Moody's investor service data that we've teamed up with Real Capital Analytics, and this is repeat sale price indices. So it accounts for mix issues similar to repeat sales indices that are used in the housing industry. This is data, I've indexed it to equal 1, in Q1 2001. That's when the data availability started. The green line represents the total market. So this is all properties, all property types in all parts of the country. And just to give you a sense of the variation, the blue line represents price gains in major markets. So obviously investors have been, certainly global investors have been much more interested in investing in safer markets. Major markets would include the obvious: Boston, New York, Chicago, San Francisco. I believe actually Miami's in this data as well. The orange line represents the apartment market. So if you're looking for a market that is potentially richly valued, it would be the apartment market. So all the dynamics I was describing about apartments and why that should be fundamentally a good place for commercial real estate, investors have bought into all of that and then some, and obviously driven down cap rates and driven up prices. And so a lot of it's already baked in. A lot of the good news is already baked in. So in a rising rate environment, this may be a place where we might see a correction, but I think it's modest. I don't think this is a bubble in any sense. And then just for context, suburban office, that's the orange line. That's the weakest market, at least in terms of pricing, and fundamentally, that's the last thing that will probably kick in. It always takes a while for that to kick in. Let me just end with one cautionary note. What could go wrong with my optimism? The thing that makes me most nervous is whether the Federal Reserve is going to be able to gracefully exit out of its very aggressive monetary policy. You can see how aggressive they've been. This shows the size of the Federal Reserve's balance sheet, the security holdings that they have on balance sheet. You can see the forecast. The forecast is simply with the assumption that the Fed will wind down its bond purchases by the end of the year and then let the maturities on its balance sheet run off as the securities on their balance sheet run off as they mature. So there will be no selling of securities. And you can see that if you kind of run the numbers, it's going to take a good solid decade for the balance sheet to get back to anything close to what you might consider normal. So this is a process. Now, in my optimistic outlook for housing, commercial real estate, and the economy, I'm using the working assumption that the Fed will be able to engineer interest rates higher, both long-term interest rates and short-term interest rates higher, consistent with an improvement in the job market. Get more jobs. As unemployment declines, the Fed will allow first long rates to rise and then ultimately short rates to rise, and they normalize monetary policy. In the context of short-term interest rates, that'll be probably sometime in early 2017. In the context of their balance sheet, it'll take a good decade for it to normalize. If we get the forecast, if the Fed is able to execute on that forecast, how I just described it, and certainly that's what they want to do, we're golden. We're going to be perfectly fine. It's going to be a good solid 5 years, good run for the economy and for the real estate markets. But this is a tricky thing. We've never been down this road before, and whether they're going to be able to execute on this in a graceful way is yet to be seen. So far, so good, and they've got all the tools necessary to do it. They've got the will to do it, and they've got the market right where they want it right now, but we'll see. I'm sure they're going to get tested again, and we'll have to see what kind of forward guidance they use to manage interest rates higher. So in my view, this is the most significant threat to my optimism. So to end with the answer to your question about is this a good time to enter in as an investor, the answer is if you're a long-term investor, easy money is over. In stock market, certainly, I think if you look at the pricing in most commercial real estate markets, not everywhere, but in aggregate. But going forward, if you buy into my economic outlook, that would suggest good, solid, if not pedestrian returns compared to what we've seen, but good, solid returns. But you have to be a longer-term investor. But you're a young guy. You should have a 10-year horizon. I covered a lot of ground. I think I addressed everyone's questions about, except for the Southeast and the Southwest. That was clearly a test. Yeah. But I think I answered everyone else's questions. Anything else you want to chat about? Yeah.
Just a quick question. Your optimism on construction, is that generally shared by other economists?
My optimism about what?
The construction risk?
Good question. Is it shared by other economists? Well, you've heard that joke about, two economists, three opinions, that kind of thing, which is true. I would say I'm more optimistic than most. Not so much about this year. I think, I'm pretty consensus oriented, but I'm much more optimistic about our prospects mid-decade and longer run. I think, and that extends from the economy to housing to commercial real estate. I think our prospects are better than most would think. Yeah. I mean, just to give you a sense of it, I said the economy is going to grow 4% in 2015. The consensus is probably closer to 3. Yeah. Frank is definitely not as optimistic as I am. 3.5. Are you at 3.5? Whoa, see, I have influence. Yeah. I'm going to be right, though. Of course, I've been wrong for a while. Yeah.
Do you have any sense about the retail market?
The retail commercial real estate market? I find that the most confusing market to evaluate because it's not homogeneous. The others are more homogeneous. There's a lot of different flavors of retail. I would be, of all the property types, from a fundamental perspective, not in terms of pricing, investing, but from absorption of space, because that's where my sort of strike zone is. I would be least optimistic about retail for a couple reasons. One is the U.S. consumer, and again, I look at everything from a 30,000-foot macroeconomic perspective, but the U.S. consumer really drove economic growth, global economic growth, for almost 30 years, between 1980 and 2005. The 80s, 90s, that's 35 years. During that period, the saving rate fell from 12, 13%, that's where it started, to a couple 3% at its low. So a 10-point decline in the saving rate over a period of 30, 35 years. A lot of that was juiced by wealthy households thinking they were wealthy, really wealthy. In fact, one of the worst things that ever happened to us was the tech bubble in the late 90s, because that's when the boomers were in their prime saving years, right? When you should be saving a lot of money. And they didn't because they thought they were set because the stock market was so high. And of course, that decline in saving rate was also driven by the increase in debt from lower middle income households that hit its apex, obviously, in the housing bubble. Saving rates going forward are not going, they're not going any lower. We went from 2 to 5 in the recession. We're at 5 now, roughly. And everything argues that it goes higher from here. Slowly, but goes higher from here. We need to save more because we didn't save enough leading up to this period. And certainly creditors, banks, lenders, they're getting more aggressive, but they're not going back to where they were. They won't be allowed to. And so low-income, middle-income households are going to have to save something. They're not going to be able to borrow and dissave. So broadly speaking, the U.S. consumer has gone from being the engine of global economic growth to being essentially along for the ride. All we really can count on for them is to do their part going forward, not to add anything. So from that broad macro perspective, it's hard to be enthusiastic about retail. And then, of course, you layer on top of that all the technological changes that are going on. If you just take a look at the retail sales report every month and look at the non-store retail component, that's where the internet activity is, and that's growing very rapidly and will continue to grow rapidly. It's been up to this point, it's only, speaking from memory, it's single-digit kind of share of retail sales, but a decade from now it's probably going to be 15, 20%, and it continue to rise. So I think it's going to be hard. I think for those two broad reasons, it's hard to be entirely enthusiastic about retail from a fundamental perspective, from an absorption perspective. Yeah.
In your positive outlook, there's sort of 3 or 4 things that seem to be different now than they have been in the past. I'm curious how you weigh them. Number 1 is student debt. I also have one child who is fortunately out and into housing. So I'll talk to that about a minute. Another one who I don't know when.
Yeah.
But debt load is extremely heavy. I know what they pay in a month for student debt, and I know that it's basically student debt or that much more housing or other housing options. So that's one. I also know that my kids are much more interested in living in an urban space, or at least a Georgetown-y type of place, as opposed to a suburb like I grew up in and where I live. That means much less housing, much smaller housing stock, much more condominium, townhouse type of outcomes, as opposed to building a 4 and 5 bedroom house, which is a difference in a job creator. The carryover of people who went through foreclosure, who are not going to end the credit tightening, all that together. I don't know what the impact is, but I hear that those people are not, and that gets kind of to the other part of that is, for most of us, my age, which is older than most of the people in this room, obviously, but probably closer to yours, the last 20 years, our house was our investment.
Yeah.
And my kids don't see their house as their investment because of what happened in the last 4 or 5 years. So they're not going to put as much money into housing as I did in my generation.
Yeah.
All of those strike me as sort of drags on getting back to a quote-unquote traditional housing curve like we saw over the last 20 years.
Yeah, all great points, and I sympathize with everything you just said. I think what it argues for is a lower home ownership rate, and obviously the flip side of that is more multifamily in urban settings. Yeah, and the other dynamic that reinforces your point is, our age, empty nesters are quickly moving into the cities in urban centers. They're not sticking around because they want liquidity as well. They've got their own retirement issues. So I think you're right. It's hard to quantify because we don't have data. I mean, believe it or not, we don't really know some really basic things that we need to know. So for example, I can't really tell you how many households were formed last year. Believe that? It's hard to believe. We're an economy producing homes and everything else based on households, and I can't tell you precisely how many households were formed last year. I can guess. And I can't tell you what the average age of the first-time home buyer is. There used to be a title company that ran a survey, and it said, the average age of the first-time home buyer was something like 32, 33 years old, which makes intuitive sense. But I can't tell you that right now. My intuition is that student loan debt, the fact that that generation of 20-somethings are behind the financial 8-ball, there's a lot of economic research that shows that your lifetime earnings are a direct function of the starting salary, and these folks are starting at much lower salaries. And certainly they've seen a lot, and it has to have affected them. And they're thinking about their home and living arrangements and everything else. So if you told me the average age of the first-time home buyer is now 35, 36, I don't know that I'd argue with you. So that would suggest less single family. That means lower home ownership for longer. It doesn't mean we're going to create less units. I firmly believe we're going to create 1.7 million units. It's the mix. And also in terms of the economic value, I said there was 4 jobs for each single family, 2, I'm rounding, for multi. So, given the implications of what I said, we're going to create fewer jobs than we normally would. But we'll get the households. But we're not. You're right. I think this is this is going to take a while to overcome. If you look at the behavior of people who lived through the Great Depression, it's startling. I mean, I calculate personal saving rates by age group. And the folks that lived through the Great Depression, they're in a different universe in terms of their saving behavior, which is a telltale for everything else they're doing and thinking. And the folks that lived through this period, it's not Great Depression-esque. It's not that. It's not Steinbeck, I'm going from Oklahoma to California. But I can't imagine it didn't have an impact. Even taking my own family, right? I live in a very nice neighborhood. The family next door, we grew up with them. They had 4 kids. I have 3. They had 4, same age. They all went to the same high school. They ran into some health issues and marital issues. They lost their home. 4 kids lost their home, parents, and that's got to have an impact, right, on my kids and their thinking about lots of things, including home ownership. So, and attitudes have definitely changed. My grandparents thought of their home as a retirement vehicle. My dad probably maybe thought of it that way. All I care about is, please, Lord, give me inflation. I can't imagine my kid thinking even that, right? So at least not now, not yet. Now, things may change. Family dynamics will change again, and they'll go 20-somethings will become 30-somethings. 30-somethings will want children, and the whole thing I'm sure will adjust again. But I completely sympathize with what you're saying. We can't not have gone through something like we just went through without having meaningful impacts, particularly on those 20-somethings and their behavior. Yeah. And just technology. I know I'm going on, but you, tough luck, you invited me. So a lot of the automakers are my clients, right? On the finance side, I do a lot of work building models for them to assess their auto loan credit risk. And so I get to talk to all the senior executives of some major companies. You know what they're observing? They're observing that kids, when they turn 16, don't get driver's license anymore. That when you and I turned 16, my God, we needed that driver's license right then and there. Our parents had to drive us down. Now, they're not getting the license. So they're like, what's going on? And for the automakers, this is key. This is really the future for them. So this group of millennials, they're weird. And we got to figure that out. Yeah.
You said technology. Do the automakers allow their workers to telecomute?
That's a good question. I don't know. Yeah. Yes, sir.
You recently spoke in Cincinnati.
Were you there?
No, I was not.
Oh, okay, good.
I read about it.
Oh, you did?
Yeah, and I'm
Jeez.
actually
You
curious.
can't hide. Yeah.
I do my best to find things.
Yeah.
You recently spoke about sort of these like second or third tier cities.
Yes.
I'm curious, what are the trends for those, particularly with attracting not only jobs, but then starting building infrastructure for real estate with multifamily, with retail, that is with mixed use.
Right.
And probably diversifying away from the big 6 and going to these smaller regions and sort of building a new economy there.
Yeah. I think a lot goes to cost structure. So, when you come out of recessions, cost structures come down pretty much across the board, and those metropolitan areas which are more desirable generally come out first. And also in those metropolitan areas that are major metropolitan areas, their cost structure actually comes down even more. They get juiced up in the good times and they get hammered in the bad times. They have big ups and downs in real estate values in those supply constrained markets. So essentially when you have really good times, they get priced out, and in the bad times their cost structure comes in, recovery begins, and they're the first to lift. But ultimately, as they lift and they bump up against the supply constraints, you can already see it in San Francisco, for example, or Miami or New York City, given house prices and condo prices and rents and everything else, it's getting pretty expensive. And as soon as that happens, then businesses start moving out and looking for lower cost areas to operate in. and that generates more job growth and more income, and those second, third tier economies begin to come back to life and start to do better. So I think we're, you remember that this chart, it's the major markets leading the way. My sense, goes to my point about getting overpriced. So what's going to happen is that attention is going to start moving towards second tier markets, third tier markets. Also, a lot depends on the labor market as well. I mean, because the big cities are going to have very tight, already labor shortages popping up in these major metropolitan areas, dries up wage costs. And so that will also push businesses to look to second, third tier metropolitan areas for growth. So I think we're pretty close to that point in time when that dynamic is going to start to unfold. And those second, third tier cities are going to become more attractive for investors and for growth and development. Some will do better than others. A lot is dependent on your legacy industrial structure. A lot of it depends on your leadership too, though, I find. You go into communities, I can pretty much tell which are going to do well and which are not over the long run because of the leadership. In terms of if you go into communities where the leadership speaks with a single voice and vision, they tend to do well. And then if you go into communities where there's just cacophony of voices, like Philadelphia, it's like that's my hometown. It's a mess. Almost by design, though. We don't want any growth in Philadelphia. I've come to realize this. We're a there's really something to this Quaker. Like my wife, if they announce any development within a 3-mile radius of my home, she's on the warpath, right? So a lot does depend on the leadership and whether you have a vision for doing things. I actually think what's going to be really key to growth going forward, though, is if you can expand and develop your centers of your educational institutions. Those are gems, and we should really be. If I were, in a smaller city or community, I'd be focused on laser beam on trying to enhance my centers of higher education. Less so on K through 12, because the K through 12, the kids will get educated and they'll leave. I'd be really focused on trying to make the community college, the state university, whatever it is, really a gem, and that'll attract faculty, and that faculty will attract business, and that business, they'll want good schools, and you'll get the K through 12. So some people are doing that, and you can feel it, in their communities. Yeah, yes, ma'am. One more question? Okay. Oh, okay. Oh, you want the microphone? Oh, sorry, I forgot. Yeah. No, go ahead. You're good.
Just going back to the savings rate, you mentioned that we've recovered to about 5% now. Given that our economy is increasingly more competitive, which also means that wages have sort of stagnated, what are your projections for how well, to what extent that will recover, and what are some of the variables that influence that?
Wage growth?
Mm-hmm.
Yeah.
And savings, the savings.
And
rate.
savings?
Yeah.
I think, wage growth has been stagnant, as you point out. I think we're on the cusp of that the dynamic between employer and employee will start to shift. That, if you look back at my profit margin graph, the flip side of that is the wage share has declined, right? So basically it's been an employer market for, since 2000, right? So labor has been taking it on the chin. Wages have been very constrained. The labor market's been very soft. But I think our biggest problem 5 years from now isn't going to be unemployment. It's going to be a lack of labor. That the demographics are very compelling. The 50-somethings, you and I are out of here, in not too long. And actually, here's an interesting factoid. 40,000 people retire every single week in the United States now, boomers. The boomers. Here's the most important factoid of the day. Who else wants a book? If you want a book, you got to give me your card, though. Yeah, only if you want it. $3.99. It's worth something. What is the largest single-year age group in the country? More of these folks than any other age. Baby boomers? Give me a number. Give me an age. You said 55?
55 to 65.
Yeah, I want a single-year age group. Yeah, you're good. Yeah, 55. You got a book if you want it. You're very skeptical, though. You're cynical, I can tell. Yeah, yeah. But you got. I'm very optimistic. And if you get my book, you got to read it. You got to read it. Yeah, okay. That represents the teeth of the boomers, and you got a lot of people over the next 10 years that are going to retire, right? And the baby boom echo, the 20-somethings, is a smaller demographic. If we don't change immigration law, which we're not going to do in the immediate future, the market's going to get really tight. And so this dynamic between employer and employee is going to shift. And this profit share is going to start to decline. The wage share is going to start to rise. So we're going to get more wage growth. It's not going to solve our problem with the income distribution. We've got other issues there, but it's going to help to address it. With the rising wage share, I also think we're going to have a rising saving rate, right? Because we haven't saved enough, and particularly people in their 40s and 50s, they need to save more, and they know it, and they're going to save more. And moreover, lower middle income households won't be able to borrow. Remember what I said, that it was the borrowing that allowed them to dissave, spend more than they earned in wages, and they can't do that anymore. So we're going to have a higher, slowly rising saving rate going forward. More wages, but a rising saving rate as well. Yeah.
I like what Bill said a little bit earlier about student loan debt, because I think that seems to have really trended upward just in the last 20 years. So do you see that trend continuing? Is it going to stabilize and go down? Because that's going to affect this really.
Yeah, I think student loan debt is a very serious problem. I think every recession at its core has a significant financial imbalance, leverage that shows up somewhere in the real economy and also in the financial system. Housing, mortgages, commercial real estate, savings and loan. There's always some fundamental structural issue. If you told me student loans are, if not at the center of the next recession, I'd say they'd be central in the next recession. Now, central, they'll be part of the story, part of the reasons why we go into recession. I don't think it's a financial system issue, though, because 80% of the student loan debt outstanding is government guaranteed. So we have, roughly speaking, 1.1 trillion in student loan debt outstanding. 900 billion of that is government guaranteed. A couple hundred billion is a private student debt. But that's high quality debt. I mean, that's great credit-worthy borrowers, co-signed. Those private student lenders got burned, and they're much more cautious. So this is a taxpayer problem. But we're going to get into the next recession, and the default rates are going to be so high, and the pressure is so severe that policymakers at that point are going to have to forgive debt or do something to significantly reduce the burden. I mean, you can already see President Obama went down that path, right? He didn't forgive debt, but he extended out maturities, lowered the maximum payment you could make was X, and so forth and so on. That's a precursor to what's going to happen in the next recession. We're going to forgive debt. So it's going to be a taxpayer problem. And if you told me we write off $250 billion, I'm making up a number, but to give you order of magnitude, $250 billion in student loan debt, in the next recession, that sounds about right to me. Now, there's going to be a quid pro quo for that, right? Because if that happens, the whole thing's going to shift, change, and probably appropriately so. In my view, student lending is wrong-headed. It juices up, it's juicing up demand, and therefore, which is bumping up against a restrained supply of educational services. And the universities, not Georgetown, but other universities, are jacking up tuition and capturing the subsidy in the student loan. It's not helping affordability. It's not helping these kids. You're larding them up with student loan debt. What we should be doing, in my view, is we should be taking that subsidy that we provide through the student loans and working to increase the supply of educational services. Not juice up demand, but increase the supply, because that will bring down tuition and make it more affordable. So how could you do that? Well, there's all kinds of creative things you could do. Like, for example, I know I'm prattling on. Maybe I should just stop right there. Should I stop? All right, okay, all right. So that's a dangerous thing, this not tell me no. In North Carolina, NC State, Siemens, and Duke have teamed up Siemens produces turbine engines. Duke needs the turbine engines to drive their electric utility facilities, and they need kids to be able, engineers and others to be able to produce the turbine engines and to maintain them and to operate them. So Duke and Siemens are providing resources to NC State, labs, universities, all the things that you would need to educate kids. And the quid pro quo is that they have some input into the curriculum process, which probably isn't, you have to be worried about educational, intellectual freedom and that kind of thing, but it's probably not a bad idea to get input from the business community on what they really want to see in the kids that are graduating from your university. I could see helping using this tax dollars, the subsidy in student loans, and taking that and incenting that kind of a process all across the country. Helping the university marry with business people and figure out ways to provide new funding to increase the amount of educational services that we're providing to our kids. So I think we need to get a lot more creative about this. But I don't think we're going to do it until we have a crisis, and the crisis is going to be in the next recession. I think student loans are going to be central to that. We're just not going to change it. Yeah, he's got the microphone.
Yeah, I got the comps, right?
Yeah,
so
you got it.
Order the prize. You actually read inside my mind when I asked a question about affordability, because it's really around access to credit for low to moderate income families. So it was encouraging that you mentioned about opening up the credit box, because I think that'll present us with the opportunity to tap into that 9 million people that are currently renting.
Yeah, absolutely.
Because they have the 700 credit score,
yeah,
but can't access the capital to buy that house. So that's very encouraging. I work with a lender in Baltimore City. I do affordable housing development there, and they actually have a non-FHA loan that allows them to reach first-time home buyers without maybe going through the rigmarole of the FHA lending process or underwriting process. So I guess the question is, how do we as future leaders, and I'm an urban planning student, how do we tap that market of 9 million renters in a way that doesn't lead to sort of the what we had in 2006?
Yeah.
So how do we tap that market in a safe and secure fashion,
right,
but still being able to be innovative and thinking about how we not only bring housing opportunities to low-income families, but how we grow the market?
Yeah, I think there's a couple of things that we need to do. I think one of the key things is financial literacy, and this was the subject matter of the speech, and a big part of the speech in Cincinnati was around financial literacy. I think if people get counseling before they get a mortgage, particularly people that are getting affordable housing loans, they may not have the same experience with financial mortgages and other financial instruments that others might. That counseling is very, very important, and making sure that they understand exactly what it is that they're committing to and getting into. And we're not very good as a nation with regard to financial literacy. I mean, when I graduated from high school, I could make a pretty good omelet. I had no idea what a mortgage was. Really? And that, same today. It's pretty much the same today. So I think, and actually we've seen through the crisis, wherever we establish counseling help for troubled homeowners, it really does make a big difference in terms of how they manage their affairs and whether they succeed in holding on to that home. So I think that's very important. I think also to help address underserved markets, we need to get away from the old approach of affordable housing goals. This was the goals that Fannie Mae and Freddie Mac had. They had to provide a certain amount of credit to underserved markets. But this turned out to be it sounds very intuitive that you give somebody a goal, that they'll go ahead and achieve it, and it's going to help achieve your target of serving these underserved markets. But that's not the way it turns out. There's all kinds of ways to game those kinds of targets and goals, and they do. I mean, it's just instinct, and it's what you see. And it's very ineffective, and the subsidy that taxpayers provide don't go to the underserved communities and households. They go to the shareholders of these institutions or the stakeholders in those institutions. So we need to get away from that, and we need to make sure that the subsidy is explicit. We raise money through the mortgage finance system, the future mortgage finance system. We charge a fee for everything that goes through the system. We raise some money, and we use that money to target it at addressing some of the market failures that are leading to markets not getting served properly. And there's a lot of things that we could do to make the market work better. I mean, in my mind, there is a market failure because there's a lack of information, right? I'll give you an example. A lot of lower income households in underserved communities, they don't have a credit score, right? Because they never had credit, but they have a utility bill, right? And they have done other things that show their willingness to pay. And that's what a credit score is all about. So we need to figure out ways to get that information, make it viable for lenders to use, and they're going to then extend more credit. But that takes money and resources, and that's what we should use this money that we're talking about for. So I don't want to go back to the way we did it. I just don't think that was effective. But I think there's good ways of designing the system so that we can really, really help these underserved communities, because I do believe there clearly are underserved communities.
Mark, I'm going to have to play the bad.
No, I'm glad you did. Yeah, thank you.
I know that you've appreciated this 30,000 view of the economy. It's been very informative. Come all the way down here from Philadelphia just to give this lecture. We deeply appreciate it, and we thank you for sharing with us of your fount of wisdom from which
thanks.
we have all drunk. We're not drunk for the last hour and a half. Let me remind you that there is a reception downstairs with lots of goodies. So we hope you'll all come one flight down and feast to your heart's content. Let's thank Mark Zandi.